Hi there, and welcome to another edition of Premier Investments and Wealth Management Financial Program. My name is Doug Wagner. I'm your host. Introduce the three gentlemen around the table here in a matter of seconds. But first, I want to make sure that you have an understanding if you're ready to be retired. It's a lot more than just, saying, oh, I got some money in a retirement account. My 401k looks pretty good. It's sort of like saying, I'm going to drive to Poughkeepsie, New York, and I'm just going to go east. If you don't have a map, you don't have a plan, then what are the chances you're going to get there successfully? Premier Investments and Wealth Management can help you. At premieriwm.com, you just click and get started. It's one of the little banner buttons up there. They'll ask you a few questions. They'll provide for you when you give them the answers. They'll provide for you a one-page Premier Vision document and a free, no-obligation meeting in order to go over what could be the roadmap for your financial future, your retirement, which may be the most important thing that you have setting in the next 20 to 50 years, depending on how old you are. PremierIWM.com. You can also call to make an appointment today, 800-383-6590. Premier Investments in Wealth Management, named Forbes 2026 Best in State Wealth Management Team. Joining me today, wealth advisor with over 31 years of experience in the investment industry, Jonas Everett. Hey, Jonas.
Hi, Doug. Good to see you, sir.
Good to see you as well. It was good to be back with you. Elias Randel is vice president. He's also a wealth advisor and the new sheriff in town here at Premier Investments and Wealth Management, certified exit planning advisor. That's a SEPA. Hello there, Elias.
Good to be with you, Doug. Thanks for being here today.
Thank you very much. Appreciate it. When are you not the new sheriff in town, or are we just going to keep that for good?
I don't know.
The sheriff in
How
town.
long am I new?
That's a good question. We'll have to get back to you on that. We'll send it out.
I could just keep being new, and if anything ever goes wrong, you can always blame the new guy. Right? Yeah, so just blame me. That's pretty good, right?
I'm not a new. That's a four-legged mountain animal. GNU. Anyway, let's go over to Roger Abel. He's president and wealth advisor at Premier Investments and Wealth Management, accredited investment fiduciary, and a certified exit planning advisor with over 22 years of experience in the investment industry. He is the big kahuna, Roger Abel.
Thank you, Doug.
You're welcome. Good to see you.
Good to see you, sir.
Fabulous show. We're getting ready to do this, and we're going to start off with you from Carlos. He wants to know, I own a small business. I've always put every extra dollar back into the company. Recently, I started thinking about my retirement and personal savings. How do you suggest business owners balance using extra cash flow to grow the business, to increase the future value, and having personal savings? This is awesome because one of the recent shows, we had like the inverse of that whole thing. You remember that? So this is like almost the upside down of this.
This individual's trying to be responsible and save. Mm-hmm. So most business owners are going to have to tackle this unless they don't plan on saving for retirement, which I don't recommend. Here's the best way to tackle this, Carlos. You need to set a date for financial independence. That doesn't mean that's the date you sell your business. It doesn't mean that's the date you retire. Okay. That means that's the date that you have a choice. Mm-hmm. And you can decide to grow or you can decide to sell. It'll be your choice. But if you do personal savings, you'll have that option. Otherwise, the business is just going to be worth what the business is worth. By setting the date of financial independence, you can back into how much you need to save. Because financial independence means this is the point in time I have enough money saved. I don't have to work anymore. And the other thing that happens when you save on your own and you exclude the value of the business from your equation, the only thing that can happen is it gets better. What if your business isn't worth anything in 20 years? There are businesses that go out of business. Mm-hmm. Different types of businesses change. Mm-hmm. Do you remember when you used to get your film developed?
Yes, I do.
What if that was your business?
Yeah,
and you didn't save because of that?
Can you say Eastman Kodak?
Right. I mean,
that's huge
but there
business.
Used to be places in town you'd go to get your film developed. They don't exist. Mm-hmm. What if your business was Blockbuster and you're renting out movies? So everybody assumes our business is going to be worth something in the future. Mm-hmm. The reality is it's completely unknown what the landscape's going to look like. So if you take the bull by the horns, you set a date of financial independence, you save, just like a normal person who has a regular job saves, nothing but good things come if your business is worth more than you think.
How many small businesses actually sell? It's around 25%.
Only 25% actually sell.
Right. So
the other ones, the people die or they go out of business.
Most likely, if you're owning and operating a small business, most likely you will not sell it. Well, 75% of those businesses do not sell ever.
Well, and then of the 25% that do sell, which ones get a premium valuation?
Right.
It's not most.
You know, it's interesting. During the big game, there was a commercial for one of the potato chip companies where the daughter, the father said, "Here, the business is yours now." And there was plenty of potatoes for the potato chip company. And I was like, well, that was a real easy transaction. I wonder who thought about that.
Not in reality. It's not that easy. Trust me.
Exactly.
So, Roger, what do you, for the business owner that says, "Oh, but Roger, my business is my retirement." How do you respond to something like that?
You're just using that as a reason to not save any money. Every business owner that has ever told me that, it's because their lifestyle is outpacing what the business is making. They don't have any extra money to save. You think of the people that have told you that. They don't have any extra money to save. They got a great lifestyle. They've got a successful business. They have no money in the bank. The most successful business owners I know, they're saving too. They have cash. They're saving money. And you know what? Maybe it's not in a traditional savings vehicle. Maybe it's they're buying real estate or they're buying land. Those are also investments. But to just say I'm only going to invest in my business, well, that's like having a super concentrated stock position. It could work out.
We see this all the time, right? And the normal person that gets a new driveway, it's a good investment for my house.
No, it's not.
Well, your house isn't a good investment. It's just a place to live.
Yeah.
That's all it is.
There's two things if someone tells me I'm only investing in my business and I'm going to work forever, those two things means you don't have any money to invest. You're finding excuses to not do it.
This is interesting because this is, again, similar to a question that we'd had before, and it's the consistency that you talked about. But the big thing is that this whole concept of certified exit planning advisors and the idea that, you know what, how do I make my way from here in the business to there where I'm retired with enough money in my pocket and able to manage that control. That's why you have the two SEPAs that are here. If you wanted a meeting with these folks, you can get it at premieriwm.com. Just go to premieriwm.com and say, hey, I want a meeting. Or you can call 800-383-6590 for that certified exit planning advisor. Jonas, next question for you from Ben, who says, I'm 29. I feel like every piece of financial advice is some version of you're young, just get started and time will help you. I know it's meant to be encouraging, but it doesn't really tell me what I should actually be doing. I don't want to coast for the next decade, assuming time will fix everything. What should someone my age be doing differently or more intentionally that can really set them up for long-term success?
Great question, Ben. Time is helpful, but direction really matters more, especially in your 20s. I would have you focus on your habits right now, and we talk about maybe finding a financial mentor. My financial mentor was a close family friend, and he owned a successful small business in town. And when I was struggling as a small business owner, I would go and hopefully he would buy me lunch because I didn't have any money to buy lunch. And he always made me focus on three things. Number one is cash flow. So basically, he wanted me to make sure that I always had enough cash flow. And he said, well, once you have that covered, if you have extra, he called it extra money ahead. If you had extra money ahead, you can send this extra money off somewhere in your contribution. So he was in the copper and the steel hauling business. So he always said, whatever you do, make sure that you have, back to those spare tires, make sure that you have an emergency fund set up. But the nice thing, Ben, about being 29 years old, picture if you were 29 years old in the middle 70s, kind of like my mom's situation. The only way to save, there was a couple ways to save. There was a Christmas club, and you could buy a bond through work. So picture this, Doug, you had to walk to the bank, open up a Christmas club, write a check and save. Ben's 29. He has all these systems in place thanks to the 401k being created in 1978. He has systems in place to fill up his spare tire. He has systems in place to get a matching contribution in his 401k. He has systems in place to start a brokerage account at his age. And really, he wants to be more intentional. A lot of it is just automation. He can be intentional about automating all these systems and formulas. And then the nice thing, Ben, you could just forget about it. You could forget about a lot of this financial stuff, maybe check in once a year. But if you have a bunch of systems in place, it's going to automatically work for you. And I know, Ben, you're not a huge fan or you don't believe in compound interest, but if you set up these automatic programs at 29, you're going to be blown away by the time you're 60.
I'm not sure I'm not sure he's not a big fan of compound interest. He just feels like, I feel like I'm not doing enough, that it's not intentional, that I'm not involved. I mean, really, this is the Ron Popeil method of investing is what it comes down to. Set it and forget it. That's what you're looking at.
Well, the stock market doesn't really care how much effort you put in. More effort doesn't get more results.
Yeah.
I think that's the fallacy of that. A lot of people feel like they need to do more. And at the end of the day, you could put all the effort in the world in and get the same result as someone who puts in zero.
Busy work sometimes in that case.
I have a suggestion for Ben or other young folks listening. You could call our office and schedule a meeting with someone to put together a strategy, or maybe Ben just wants to know, I'm doing all these things. What does this look? What is this going to look like for me in the future? So partnering with someone to help you let's paint the financial picture. You're doing these things. Here's what it means. And a lot of times when you have a responsible person like this, you're not overhauling, the engine to the car, maybe just fine tuning it a little bit and getting them. They're already pointed in the right direction, but maybe we accelerate in that direction a little bit more too.
That's an idea. What's the phone number they can call if they want to make an appointment?
It is 800-383-6590.
Doing my job for me. I love that. Welcome back to the Premier Investments and Wealth Management Financial Program. Elias Randel, Jonas Everett, Roger Abel, Doug Wagner with you. PremierIWM.com is the website. Get in touch with them. They will help you create the blueprint, the map, whatever you want to call it. And for you, it's fingerprint. Your unique situation, whether you're Ben at 29 or you're me at 58, does not matter. Premier Investments in Wealth Management, named a Forbes 2026 Best in State Wealth Management Teams. Back to you. Madison wants to know, my spouse and I are both attorneys with a household income of $330,000. We just had our first child. We're working to increase our emergency fund based on the increase in household expenses. With daycare and everything else, our new monthly expenses are about $10,000. We are aiming for $30,000 in emergency fund, as we think that if one of us lost a job, the other income could carry most of the load. So this fund would really be just supplemental and could stretch longer. Is that a reasonable way to think about an emergency fund for a dual income household, or should we be saving more, Elias?
That is a reasonable way to think about it. And for dual income households, an emergency fund can be sized out a little differently than the traditional 3 to 6 months. So my take on this question, it sounds like if one of them were to lose a job, they're not going to be just living off the emergency fund to get by on a month-to-month basis. So step one, evaluate how long you could go on one income. I mean, if one income can cover everything, then yeah, absolutely. I think 30,000 is plenty in this situation. Now, what you are prepared for, if both of you are not working at the same time, you can go 3 months. So after one, evaluate how far one income can take you. Step two, I would like to see in this exercise is if you both were not working, this 3 months, does that sound good? Do you think you can make that work? You just had a new baby. I think there might be an argument here that maybe it should be beefed up a little bit more.
Yeah. I mean, especially when you have that extra child, the new child in there too, because if it's just a couple of adults, you can work a lot and jimmy a lot of things up. But
correct.
When you got a baby, there are certain things you just got to have that you can't do without.
Right. So So I think it just takes a little bit more thought, a little bit more evaluation. And one, if you can live off of one income in this situation, I think you're good. Some other things to consider beyond just rule of thumb of 3 to 6 months for emergency fund, really look at, and it sounds like they've looked at what they're spending on a monthly basis. Also look at what's your potential for, like, if worst case scenario, you have emergencies and then someone needs the emergency room or the hospital. You could even look at, like, what are my out of pocket maxes for the year? And if everything went wrong at once, how much money would I need to be able to access?
We talked about that things come in threes before. That whole thing where things happen that way. So when catastrophe occurs, be prepared for it. I guess that's the emergency fund, right?
It's always something.
It's
usually 3 of them. It's always 3 somethings at one time.
Premier Investments in Wealth Management at 800-383-6590. You can call today to make your appointment, or you can make it online at premieriwm.com, and you can even see the advisor before you meet with them by going through and clicking on them. Make your appointment that way as well for Premier Investments in Wealth Management, named to Forbes 2026 Best in State Wealth Management Team. Question for the panel here. Luke wants to know, when people think about financial mistakes, they usually picture big, dramatic decisions, bad investments, major debt, or market timing gone wrong. But I'm curious about the smaller, everyday habits that don't seem like a big deal in the moment. What are the quiet financial habits you see that slowly hurt people over decades? The ones that don't feel dangerous now, but really add up over time.
Should have done this in the Halloween show.
Jonas, what's slowly eating them from the inside?
Luke, great question.
I am your father.
I am your financial father. Great question, Luke. I'm going to piggyback on Elias's idea. Let's start the year here, and let's not overextend ourselves by using the credit card, by thinking that we're not going to have any expenses this year. So let's go ahead. Let's piggyback off of Elias's idea. Let's go ahead and put $5,000 away for maybe a vacation. Let's put $5,000 away for a home repair before it happens, Doug.
Mm-hmm.
Let's put $5,000 away for a car repair. Mm-hmm. And let's do that in January and February. And let's not act like when that happens in April, May, June, July, and August, when those 3 big ticket bills come up, right. Let's not act like that they don't happen each year. Mm-hmm. Let's not act like you're a victim, or that, I'm so surprised by this and have to use your credit card. Yeah. If you're a financial adult and if you're a homeowner, you're just going to have these things happen. If you have a family, you're going to go on vacation. Don't act so surprised, Luke. Let's go ahead and fill up the spare tire. Let's do it in threes, like Elias said. Let's go ahead. $5,000 for the home, $5,000 for the vacation, $5,000 for the car, right off the bat. Bam, boom, bam, right in January,
like
February.
Batman. Just like boom, pow, sacco.
Happening.
This is great. Roger, what is your perspective on Luke's question?
I think this is kind of a cool question because he asks about the small things that don't seem like a problem.
Yeah.
And I put down putting all of your money into the pre-tax retirement and not considering future tax liability. And I think people don't realize that if 22 years old, if you put everything into the pre-tax retirement account at your employer, you're going to have a tax problem at some point in the future. None of that money's been taxed, and that's a compounding tax problem. Mm-hmm. Whether you're going to realize it or your beneficiaries, I think just indiscriminately putting it all into the traditional 401k can lead up to a big problem that nobody really sees as a problem while it's going on. If you went out to some of our best savers and said, what is one thing you would have done different had you have known, they most would tell you, we wish we would have put more into a Roth and less into this taxable account now that we have to pay 22 to 32% in tax every time we take it out.
That is a good one. A lot of people do have that sentiment. That's a good one.
Yeah, makes sense. That's good. You know what? The other thing that I think that so many people get wrapped up in is something where we're going on vacation here in a couple of weeks. And so I've already put away money because I'm going to be responsible for the meals while we're on vacation, put that away. Meanwhile, we have a refrigerator issue and a plumbing issue that have to be taken care of. So I'm like, okay,
Ouch.
well, no, that's the whole thing is like, I'm not going to use credit card because I put that money aside as I've been going through. But there are a lot of people who haven't, because what they've got caught up in is let's keep up with the Joneses. And they're looking what everybody else has, Elias.
Well, and that was for me, and I don't really know that that's a smaller thing. I think that's one of the main things holding people back. And you can call it keeping up with the Joneses. Another way to refer to it is you want a 3-diamond lifestyle, but you have a 1-diamond budget.
Yeah.
And it's kind of, if you think about, you get your first job, let's just for ease of conversation, you're making $50,000 a year. Well, you're living like you're making $50,000 a year, right? There's not much there to live much luxury. Well, you work, okay, you're doing a good job. Now you're making $100,000 a year, but you start living like you're making $150,000, and you continue throughout your career. Now you're making $200,000 a year, but you're living like you're making $400,000. So that's what I mean when I say it's a 3-diamond lifestyle on a 1-diamond budget.
Yeah, champagne dreams and Miller High Life budget. It's the
champagne and beers. So you're right there. Can we do a commercial for them?
I know somebody. Oh, not getting paid here on that. No, I do know one thing though. Is there's somebody I know who says they have their like motto, a little thing behind their desk says, a person who lives within their means suffers from a lack of creativity. I'm like, that's
a person who lives within their means suffers from a lack of creativity.
Yeah, and I was like, that's an outcome.
Probably not a great one. But it is one. You're right.
So you never become. So the trade-off is, I never become financially independent, but I'm creative.
No, but hey, I'm creative enough to do what I want now because they can create plenty of debt. That's the whole point.
Don't they call that YOLO?
Yeah. You only live once, right?
Yeah.
That's too much. That's way too much. Premier Investments and Wealth Management. You go over to the website at premieriwm.com. They've got a whole array of downloadable stuff that you can read and reread because you're going to want to go back to it. I would recommend printing it off and then just saving it and saying to myself, you know what, I'm going to read one of these each week and I'm going to go back to the beginning and read them over and over again. Check out all the stuff that they have as far as the podcast. They have the visuals that they do on YouTube, Behind the Wealth, and then other ones that are out there. It's never a bad time to educate yourself and to really consume as much as you possibly can about your financial future and how to get to where you need to go. There's no such thing as a stupid question when it comes to your finances. Premier Investments and Wealth Management named to Forbes Best in State 2026 Wealth Management Teams. Jonas, we've got a question for you from Jonah, who says, I'm 38, single, and recently hit my savings goal for a future home. I'm no longer sure when or where I'll buy. I now have extra cash flow each month. I'm torn between paying off low-interest student loans, investing more in a taxable account, or using the money for lifestyle upgrades like buying a car. Once you hit a major savings goal and have flexibility again, how do you decide what you should do next?
Great job, Jonah. Sounds like you've done a whale of a job here.
Well done.
Reaching a savings goal creates flexibility, and you've done that. And basically, at this point, we need to make a great financial decision, and you cannot have any fatigue on this. And what I mean is no delays on this amount of money that you had earmarked. It was almost mental accounting, Jonah, where you had this money going away for your future home, and you're putting that away each month. Let's redirect that, and you have some options. You could redirect that to debt, investing, and lifestyle or lifestyle upgrades. One of the things that I wanted to point out, Jonah, is it's not an all or nothing decision. You could do all three of these programs. A lot of people kind of get to thinking that they need to make a definite decision, and maybe Jonah just thinks, I'm going to go out and just buy a new Lexus. I deserve it. I'm going to use the money I've been saving and increase my lifestyle. But actually, you could do all three. You could start paying extra payments on your debt. I just met with a customer, and they're in their 50s, but they're still putting $100 away. They're never going to have their mortgage paid off for retirement, but they're still putting $100 away extra on their mortgage. So you can pay extra on debt. You could start investing. So you could go to your 401k plan over and above the match. And maybe if you're doing 10%, maybe you could just go ahead and max it out. Maybe you could do 15%. And then maybe you could just update your lifestyle a little bit more. Maybe wear one of a snazzy shirt to the office like Elias does every once in a while. Go spring, go buy yourself something nice, but don't get carried away. Don't go high on the hog with this.
Don't go buying gold shoes, I'm telling you.
Don't go
right
buying
now,
gold shoes like Doug Wagner does. So after reaching a goal, the decision isn't about what you should do next. It should be basically about how well you do something next.
Jonas, do you ever recommend when someone hits a goal, like giving yourself a little pat on the back?
Absolutely. You have to enjoy this stuff. Yeah, the Everetts are big fans of vacations, and we're going to go celebrate by giving 6-foot Mouse our credit card in Orlando over spring break and see if he still has the one from 2019. And we'll give him, but we're not using the credit card, obviously, if you've listened to this show. But we're going to go celebrate. We like this is a senior trip, and we like to take vacations, and I drive modest cars, and I think we live in a modest house. But the Everetts like these little vacations that we go on. But this is a bigger one.
Could you get my card back while you're there? Nikki took mine.
I think if you tip them over, everybody's card in America is going to come out.
That's great.
Take some videos while you're there of America's favorite place.
Will do.
Where everybody's happy all day long.
By the way, your Bible study teacher from elementary school called your church, said, "Good on you for remembering Jonah and the whale." That was good. Well done.
Thank you, Doug.
You're welcome. Natalie's got a question. Roger, I'm going to send this one over to you. She says, I'm currently saving about 25% of my income between retirement and other savings, and I'm starting to wonder if I'm squeezing my lifestyle more than I need to. How do you know when you've crossed the line from being disciplined to saving too much at the expense of enjoying your life now?
Natalie, congrats. That's amazing. You're saving 25%. I wish more people got super aggressive. I don't know how young you are, but this is actually a fun scenario for us to do, because many times we're running financial plans, not necessarily to show Natalie she's okay, because she probably doesn't have a deficit, but we're really trying to show her she could have some balance in her life. This is how much we need to be saving. Maybe you could go back to 18% and take the other 7% and apply it to your lifestyle, because I think we talked earlier about YOLO. Well, we do only live once, but let's do it responsibly, make sure our retirement needs and our data financial independence are set. We know what we need to do. Beyond that, what the financial plan does is it gives you permission to spend the rest of it. And this is really common for someone who's never sat down and figured out what their goals and priorities are, especially if they're really scared they're not going to have enough money. They tend to oversave, which honestly is hard to do. No one's ever really told me they wish they would have saved less. But there are people that I have as customers who would tell you, I wish I would have done more when I was healthier. I had the extra money to do it. Now I have a big pile of money I'm never going to spend. And this is where we can bring balance to somebody's financial picture.
And Roger, you do a good job, because we have customers that are scared of spending money. They're flat out scared of spending money, and they've done a fantastic job spending money. And what Elias and Roger do is they carve out this money in the financial plan for these vacations, and just having somebody tell you it's okay, especially if you're afraid to spend money. And a lot of the boomers, they're just flat out afraid to spend money. And when it comes to their 401ks or their retirement accounts, one excuse that they make, like Roger said, was, "Oh, I have to pay taxes on it. I'm not gonna touch it until I have to." Well, what good is that if you come in and do a financial plan and you have an advisor say, "Take $15,000 out, go visit the grandkids once a year. It's okay, because your kids are making more money than you, and they're at a higher tax bracket. So if something happens to you and you walk out of life right now, the kids are in a 45% tax bracket. You're at a 10% federal tax bracket. Go ahead and have some fun once a year.
This makes me think that, at some point, the one-page Premier Vision document, Elias, I talk about it as a roadmap. Really, it turns into that because it gives you a green means go, I can do this, or red means stop, maybe I shouldn't be doing this, for indications like this, as far as wanting to maybe extend their lifestyle a little bit. The final thing before I kick it over to you here real quick is the idea that if she's asking this question in the first place, maybe she's already hit that line where she's crossed it, where she says, maybe I'm saving too much at the expense of what I could be getting now out of life.
It's very possible, and working on this can bring more balance to the relationship with money, just more balance. It can also eliminate sometimes people who are very good savers, and Jonas mentioned they might be scared of spending money, or it makes them feel guilty. A lot of times what we'll see is we're helping eliminate some of those negative emotions where, hey, you're on track long term, you're doing the things you should be doing, and don't feel guilty because you go buy yourself a new vehicle and you paid cash for it. Right? Not every decision has to be made with how do I get as much into my accounts at all times.
Natalie, these guys would tell you it starts with a financial plan, and really that's the one thing, no matter what your age, you could benefit from. Financial plan, the Premier Vision document. It's only one page, and you can get it at premieriwm.com. Click Get Started to answer a couple of questions. They'll even give you a no-obligation free meeting with them so that they can talk you through the document and you can understand it better. 800-383-6590, Premier Investments in Wealth Management, named to Forbes 2026 Best in State Wealth Management Team. Back to you from a question from Aaron. Elias, I'm 30 years old, getting married later this year. Congratulations. Still have $28,000 or so in student loan debt. I also have a brokerage account with enough in it to completely pay the loans off. Would it make sense to close out the brokerage account and wipe out the debt before we get married, or is it better to keep the investments and bring the loans into the marriage with a plan to pay them down over time?
My first question to Aaron, I would ask Aaron, have you talked with your future spouse about this? So I would want to know that. And then I think the things to consider and talk about, and, we could get very calculated with this and say, well, if you compare the cost of the debt versus potential investment returns, people spend too much time thinking about stuff like that. You have money in a brokerage account that's equal to or more than your student loan debt. So what is stopping you from paying it off? I like to keep it simple. I really think just go ahead, pay it off. The less debt you have in general, I think the better off you will be long-term financially. So now if you really need to and you want to compare the interest rate versus what you think you can make and you want to get lost in all those numbers, that's fine. You can do that, but in general, I would just say what's stopping you from paying off the debt. And if you haven't talked with your future spouse about it, it is something you should talk about. I think that's the adult thing to do.
Yeah. Is there one correct answer? Out of everything. It sounds like there's options of things that you have.
I think in our industry in general, there's a lot of times many options. It's really what aligns with your goals, values, and what you're trying to accomplish. And our goal is to work with people and figure out what makes sense for their unique situation. One person might be take this money out and pay it off. One person might not be. They might be high wage earners and they're paying 20% capital gains. They could be low and there's no capital gains tax. So there's a lot of different moving parts, but I think getting the debt cleaned up is likely the best thing to do. There's no penalties to take out the money out of a brokerage account. So it's really no different than paying with cash other than you're selling stocks.
Add anything, Jonas?
She's obviously financially responsible. She has a brokerage account built up, and not a lot on the student loan debt at $28,000. So I like that idea. That's going to free up a monthly payment. But I also like Elias's idea. Maybe her future husband has a student loan debt too, so they need to open up their finances and get a strategy together and just start by identifying which bill each spouse is going to pay, who makes more money, and be open about it, and make sure that you don't have any money fights at that point.
Yeah, or just figure out what the regime is, because maybe the money goes into one pot and then somebody's in charge of paying all the bills. But everybody still knows. They're young enough, they can figure that out, but it's probably better not to do that on the fly. It's just get that sorted out before you go into the whole thing, rather on the back end of it. The final question here of this edition of Premier Investments in Wealth Management, right here on your radio, YouTube, and worldwide, and the free iHeartRadio app. Sophie wants to know, I see people online constantly talking about their net worth like it's the ultimate scorecard for financial success. Does net worth really matter that much in real life, or are there better ways to measure whether you're actually doing well financially? I'm going to put it out for the table. Who's going to grab this one first?
Well, we kind of talked about this, where there's a misconception that people's homes are a great investment, and every time they do a home upgrade, they rationalize a major expense by, well, it's a great investment in my home. Well, homes are just a place to live. So that would be an idea of having a higher net worth in your home, but not having any money on the outside. So I think you have to have different kinds of net worth, but net worth that pay you a paycheck in retirement someday, or someday before retirement. So it has to be, kind of picture a farm, Doug. It has to be a net worth that you have somewhere that's kicking off a yield for you that can replace a paycheck for you. Yeah. That's the best kind of net worth.
I think net worth is meaningful. I would focus on investable net worth. Mm-hmm. So that's what you own minus your house.
Thank you.
Here's the other thing it can do, and I don't think people talk about this much, but as you age, you hopefully make better money decisions. 53 is considered like the optimal age for money decisions. But if you start to ask yourself when you're going to buy something, does this increase or decrease my net worth over the next 10 or 15 years? It could prevent you from making poor choices on spending. Just think about that. Does this purchase increase or decrease my net worth? Mm-hmm. And if it decreases it, well, maybe you won't do it, or maybe you won't do it to the level it's going to hurt you. And probably the easiest one to think of is that expensive new car.
Right.
If you sat down and said, well, this $100,000 SUV, because that's what they are now, does this increase or decrease my net worth over the next 10 years? Well, it decreases it by 60-ish thousand.
Yeah.
Is that something you want to do? And then maybe it makes you think a little bit different about it versus just, oh, yeah, I have a new car and I have a payment. So you can turn things into the net worth terms.
Elias?
Here's where I think it matters, what I think is important about it. I think for young people, when you're making, I'll start with younger people getting started. When you're making a goal, I think tracking your net worth is probably a reasonable thing to do, because most people, especially if you go to college, you're going to start out with student loan debt. So I think if you could make a goal to get to just zero or not.
Just a modest goal, just get to zero.
Just not like zero. Not a negative net worth like how most people start out. So step one, let's get that to zero, which would require either putting away some money or paying down debt, both good things to do. And then in relationship to the work that we do, we're really working with people's investment assets. So then I think you should track your net worth, but for the sake of your financial independence, like your house, you can take that, the value of your home, you can take out of that number. No one uses their home to provide income. And the other practical reality is no one downsizes. People say, well, I'm going to downsize in retirement. Yeah, you might have a smaller place to live. Square footage might downsize, but your total value, like if you're living in a $600,000 house, you're not going to go live in a $100,000 place. It doesn't work like that.
You're buying a $650,000
yeah.
smaller place.
Right.
Just nicer.
Yeah. You might buy an apartment. You might buy a condo. You're maybe something more convenient, but you're not downsizing the price. So Go ahead.
No, it really makes sense. And one of the other things, too, I was thinking as we were going through this is that when you work with Premier Investments in Wealth Management, it's more than just about the financial bottom line, because ultimately the most expensive thing you will ever do in your life is have children. And that will just drive your net worth down for quite a few years just because that's just what it does.
Are you serious?
So the decision.
Well, I know.
No.
That's a bad decision. Try you seriously.
Yeah. So you shouldn't make the decision to have a family based on your net worth.
Exactly.
Billy
That's what I was
Goat
saying.
Scrim over there, like eat all the children. Or
My
what?
advice: just crush the birth rates of America.
Exactly. That's, just sleep in separate rooms, not just separate beds, to make sure that that's
Well,
taken
you know
care of.
what's ironic though?
What?
People probably spend more on their cars than they do on their kids, raising their kids.
That's really interesting.
So
Yeah.
if you start to add up the price of what some people spend on vehicles and think nothing of it,
Mhm.
and then they say, "Well, it's going to cost $250,000 to raise a kid."
Yeah.
Well, how much did you waste on a lot?
Jonas, 2012, got my 2012 vehicle.
The irony is Roger's so right. We have 4 cars in the Everett family, and the registrations come due in March. So the used vehicles, the registrations are $51, and I had to buy my wife a new SUV 3 years ago.
Yeah.
$451 for that registration. So not quite sure what the car registration pays for, but it's a lot more for a newer car than it is a used car.
Somebody's salary somewhere.
Mhm.
So, yeah, you're right about that. There's a lot of these things. And you know what? It's nice to get a perspective from folks who work with people from all over the economic spectrum. They have people who are, wage earners. They have people who are business owners. They have people who are on commission. They have people who live off of the investments that they've made. At Premier Investments in Wealth Management, you are one of many, but you're the individual, the only one of you, right? And that's why they treat you like an individual. Your own little financial fingerprint is what they're trying to determine at premieriwm.com. Click Get Started, answer a few questions. They'll provide you the one-page Premier Vision document as well as a free meeting to go over it so you can look inside that roadmap and see what it's like. What's it going to be like to get to my dream of financial independence? I think of the Financial Independence Day, Roger, and I always think of Jeff Goldblum and Will Smith with the fat lady, the cigars at the end of that movie. And I'm thinking that's Financial Independence Day, just doing that, saying, hey, I've made it. But you're not done there, and they know that. You've got lots of life to live. They want to help you live it to the fullest in every way. Premier Investments in Wealth Management at premieriwm.com. You can call 800-383-6590. It's 800-383-6590. Premier Investments in Wealth Management named a Forbes 2026 Best in State Wealth Management Team. For the Big Kahuna, Roger Abel. For Jonas Everett. For Elias Randel, my name's Doug Wagner. Thanks for listening. Thanks for watching. We'll talk to you again next week.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments in Wealth Management and LPL Financial do not provide specific individualized tax or legal advice. We suggest that you discuss your specific situation with a qualified tax or legal advisor. Rebalancing a portfolio may cause investors to incur tax liabilities and or transaction costs, and does not assure a profit or protect against loss. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly.
There's no assurance that the techniques and strategies discussed are suitable for all investors, yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks including possible loss of
There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Dollar cost averaging involves continuous investment in securities, regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets. Contributions to a traditional IRA may be tax deductible in the contribution year, with current income tax due at withdrawal. Withdrawals prior to age 59.5 may result in a 10% IRS penalty tax in addition to current income tax. A Roth IRA offers tax deferral on any earnings in the account. Qualified withdrawals of earnings from the account are tax-free. Withdrawals of earnings prior to age 59.5 or prior to the account being open for 5 years, whichever is later, may result in a 10% IRS penalty tax. Limitations and restrictions may apply. A plan participant leaving an employer typically has 4 options and may engage in a combination of these options, each choice offering advantages and disadvantages. Those options include leave the money in their former employer's plan if permitted, roll over the assets to their new employer's plan if one is available, and rollovers are permitted, roll over to an IRA, or cash out the account value. Forbes' Best in State Wealth Management Team's ranking was developed by Shook Research and is based on in-person, virtual, and telephone due diligence meetings, and a ranking algorithm that includes a measure of each team's best practices, client retention, industry experience, review of compliance records, firm nominations, and quantitative criteria, including assets under management and revenue generated for their firm. Investment performance is not a criterion because client objectives and risk tolerances vary, and advisors rarely have audited performance reports. Shook's research and rankings provide opinions intended to help investors choose the right financial advisor and team, and are not indicative of future performance or representative of any one client's experience. Past performance is not an indication of future results. Neither Forbes nor Shook Research receive compensation in exchange for placement on the ranking. For more information, please see www.shookresearch.com. Shook is a registered trademark of Shook Research, LLC.